Hi everyone. So welcome to today's session. So I want to talk to you guys a little bit about cruising through the current market volatility that we've been observing over the last 7 to 10 days. So I think it's been a bit of a uncertain time because of Russia's attack on Ukraine. But at the outset, I want to sort of assure you that you know this is a passing phase in the market, and it's not the first time that a war has happened. And usually such times, there's a lot of panic, and people tend to feel uncomfortable. But in fact, these are usually the best times to sort of invest in the market. And I'll explain to you why I'm saying what I'm saying. So, one is it's sort of important to understand that India is fundamentally on a very strong long-term growth upcycle. And the reason I say it is that there are three important long-term cycles which are turning around. So one is that the housing cycle has turned around after almost 7 to 8 years. As you can see, there has been a dip in the inventory of housing in both tier one and tier two cities, which kind of clearly indicates that demand is now outpacing supply. Even if you see the average prices of housing, for new launches and for available units, they are on the uprise. Now, the other second important cycle which seems to have turned around is the banking cycle. So if you see, the over the last sort of 7 to 8 years, what has happened is the entire banking cycle, has gone through, a phase of consolidation where, as you can see, like starting from 2013, we saw like a very steep increase in the NPL ratio of banks. Right? So this is clearly on the down. This is clearly on the downturn. So as you can see, like the peak was at about 12 to 13%. We are now somewhere at about 6 to 7%. So it's sort of a pretty healthy trend. You can also see the systemic credit growth. So credit growth, which is again an indication of how quickly the economy is growing or how quickly the the loans and the credit in the economy is flowing. That had bottomed out at about 5% in April during the second wave of the pandemic, and in December this number was close to about 9%. So again, that's also a healthy uptick. And third, another big important lever is corporate earnings. So as you can see, from FY12 to FY19, corporate earnings grew at a meager 3 to 4%. Now this number is expected to increase to about 15% in the next 3 to 4 years. So what happens is when corporate earnings grow, earnings are they say markets are slaves of earnings. So if earnings are growing at that kind of a pace, even markets are likely to grow at a healthy pace. Another important thing which I want to draw your attention to is the growth in the economy. So the economy right now, if you see, if we had taken the pre-pandemic path, the economy is growing at a much faster pace than even what it was growing before the pandemic started. So, and one very important indication of that is the government of India's cash balance with the RBI. So almost 5 lakh crores is sitting with the RBI in the form of cash. So almost 3% of India's GDP is sitting with RBI doing sort of nothing. So this is sort of showing you, how strong the cash generating ability of the economy is. And that's, a large reason for that is the strong tax collections that we've been seeing. Also, there has been an increase in the announcements of capex from a lot of the large corporates. So all the way starting from the Tatas to Adani and Reliance. I mean, everyone's been announcing a lot of capex. So again, this is a good early indicator of the capex upcycle. There is also a substantial increase in the capex spending from both the central government and the state governments. Also, as you can see, like so what we are saying is that 2003 to 2008 was probably one of the best upcycles that India has seen in recent times. And we think that we are now in the early stages of another upcycle. So as you can see, capacity utilization had bottomed out at about 67%. Now it's close to about 60-65%. So it seems like capacity utilization will only increase going forward. Also, the cash flow from operations to capex is one of the big indicators of the start of an upcycle. So as you can see, in 2002 to 2003, cash flow from operations were very strong, and that's what sort of started the entire capex cycle. And then, as you can see, it sort of dropped quite a bit, and then again, it's sort of now at the same levels at what we saw in 2003, 2004. So somewhere, it seems like we are again on the cusp of a long upcycle. One other very important sort of shift that we are seeing is that because of this China plus one strategy, manufacturing. So if you see the history of manufacturing, it shifted from say the US to Japan after World War II. In wave two, it shifted from Japan and Europe to Southeast Asian countries like South Korea. In wave three, this moved from Southeast Asia to China. And so the last 20 years, where we've seen like an explosive growth of China's economy, has been because of this. And now in wave four, we are seeing a strong shift from from China to India. And even the various PLI schemes that the government is rolling out, various incentive schemes both on the export side and the import side, it seems like government wants to give a big impetus to manufacturing in India. So as and now the other thing is, now if we see the Nifty PE, the Nifty EPS, and the corporate profits to GDP. So Nifty, corporate profits to GDP are at about 3%. So this is one of the lowest it has been in almost 2 decades. And again, this is again an indication of the start of a long upcycle. Also, your Nifty PE is at about 20 times 1 year forward, which is again, it's corrected from the recent peak, but it's also very healthy if you're expected to grow at about 15 to 20% in the next 3 to 4 years. This Nifty P is also very healthy. So, all in all, what I'm trying to explain is that, India is on a structural upcycle. Valuations are healthy. A lot of the metrics which typically indicate the start of a capex cycle or a long upcycle are in place. So also India is amongst the large economies. India is the fastest growing and is likely to be the fastest growing in the years to come. So as you can see, this is a projection of the GDP growth. So both nominal GDP and real GDP are expected to grow at a very healthy pace. So India would be one of the fastest growing economies in the world, and the fastest growing economy amongst the largest economies. So it's clearly indicating that we are heading in a very positive sort of a direction. Now I think recently there have been many concerns around the corrections or the volatility that we've seen in the markets. So I just want to draw your attention to this chart. And what this chart shows is that this shows you the market cycle from 2003 to 2008. And as you can see, that was one of the longest bull runs and most structural bull runs India has seen. So as you can see, there have been several instances of 15 to 16%, even as much as 30% corrections, in that time period. So the corrections that we are seeing now are also a very normal part of any sort of structural upcycle. So for example, some of the recent correction that we've seen on account of Russia, you have to understand that Russia or any country, like when it invades another country, that is usually a time when markets are at their at that point of maximum pessimism, and because of that, there have been great points to enter into the market. So so that's a, I mean, there's enough data to show that when there is an invasion or when markets are correcting, that's a great time to either start an SIP or continue investing in the market, because when you look back in hindsight, you realize that that was a good point to sort of enter. And having 15% corrections is very normal in a structural bull market. And this is the 2003 to 2008 upcycle in India is the most evident example of that. One of the other concerns that people have is that now interest rates are likely to rise. Fed has been sort of talking about a hawkish policy where they're talking about increasing the interest rates. So I just want to draw your attention to the fact that in almost each of those instances, starting all the way from February, 1983 to as recent as November 2015, the markets have done very well in every period of in every period of the sort of interest rate rise. So also India is macroeconomically way stronger than it's ever been. Whether you see our forex reserves, whether you see our internal growth, whether you see the push of the government towards growth, whether you see the PLI scheme that the government is launching, also the recent capex announcements and corporate earnings. I mean, it is very clear that India is on a fundamentally very strong sort of a chart, and therefore you should continue remaining invested in India. In fact, I think that it's a very lucky time in our lifetime to be part of such a to be at the cusp of such a structural upcycle, because this is where the big money in the market is made. One of the other very important learnings is that time in the market is more important than time in the market. So if we see Nifty in the last 30 years, it has given a CAGR of about 12%, which is a return of about 30x. Now, if you try to time the Nifty and you missed days, your returns would have come down from 30x to just 3x. So that's why data from the globe points to just one thing: how vulnerable returns are to whether you capitalize or you miss out on the best days of the market. And the only way to make use of the best days of the market is is by being in the market or by remaining invested. By trying to time the market and by being out of it, you are not going to be able to make use of these days. So that's why I think there are a lot of questions oftentimes about what should we do when the markets are going down. What you should do is you should continue doing your SIP. If you're sitting on the fence thinking that when will I invest, you should invest now, because you cannot time these things. The only way that you make big money is by being in the market, and that's why remaining invested, doing an SIP, and increasing your allocation when the markets are falling. I mean, if you can do those things, I mean, you will reap a lot of benefit in the years to come. So in summary, we are going into structural upcycle after almost 15 years. GDP is expected to grow very strongly in the next 4 to 5 years. Compared to like say the last 7-8 years of growth of only 3 to 4%. Corporate profits are expected to grow by over 15% in the next 5 years. Markets have done well in previous episodes of Fed hike. Markets have also done well in previous episodes of war as well. And so corrections are part of any bull market, and hence you should use these opportunities and these corrections to buy into the market. Now a little bit quickly just to wrap around what we offer at Teji Mandi. So we are a subsidiary of the Motilal Oswal Group, and we are a SEBI registered investment advisor. So what we do is we provide you with an all-weather model portfolio of about 15 to 18 stocks. And what we do is we give you regular rebalance updates, and we've integrated with all the top discount and full service brokers, and through a one-click mechanism you can invest in our portfolio. So our investment philosophy has two components to it. One is the stock picking side of it, and one is the rebalancing side of it. So when it comes to stock picking, we track data from across 30 different sectors, subsectors. We have quantitative screeners across accounting, valuation, and growth parameters. We do a detailed balance sheet, income statement, and cash flow analysis. Now, in terms of the portfolio construction, we have two parts of the portfolio. One is the tactical bets. So these are like about 20% of the portfolio, and these are relevant from say a 3 to 6 month perspective. So some examples of triggers could be industry consolidation, or where there's a government policy or where there's a change in government policy that could create an opportunity in certain companies. Like for example, what we're seeing with the PLI schemes in several sectors. Or there could be that there's a very strong industry tailwind because of which certain stocks or sectors are likely to do well. Then long-term winners. So this is about 80% of the portfolio. So these are companies which have a proven growth track record, very good capital allocation, good strong growth triggers ahead, and also in some cases some stocks may be beaten down out of shape. So we may consider investing in those stocks. Then there's also disciplined rebalancing. So just as buying is important, even the rebalancing strategy is as important. So, if the investment thesis is no longer valid due to entry of a large competitor, or company's capital allocation policy may have changed, or there is a substantially better risk reward opportunity available in another stock or sector, we may consider moving from one stock to another. Now, just some highlights from some of the exited stocks. So we had CDSL, which is again, it's a very asset-light model. It's a near sort of a duopoly industry. And because of the robust activity in capital markets, the earnings of this company did very well. And as you can see, we sort of had a handsome exit in the stock. Now, Tata Power is again one of India's largest power companies, and they have a strong focus on the whole EV sort of transmission stack. And because of that, again the stock did very well, as you can see. And because of our stock picking strategy and our rebalancing strategy, as you can see, the portfolio has done very well over a period of time. So if you had invested with us in the right from the beginning, then the Teji Mandi portfolio would have been almost 2.5 times, whereas the market in that same time period has only gone up 1.5 times. So what do you get when you pay for Teji Mandi? You get access to an actively managed Teji Mandi portfolio. You get regular rebalancing updates. You get regular portfolio updates on all the stocks. You get all the rationales. It's a simple, one-click buy, sell, and rebalance facility through the top brokers of your choice. And we also provide some very easy to understand stock market education. How much do we charge? So if you take a 6-month plan, it's 149 per month. And if you take the 3-month plan, it is 199 per month. So good thing about our model is it's a flat fee model. Regardless of how much you invest, our prices remain the same. Now I'll just take some questions that we've received from some of our investors. Yeah, hi. So, we've received a lot of questions around, what should we do around the current market? Portfolio is down. Should we do a lump sum? So, what I wanted to explain to you is that, and I've explained it earlier in the presentation also, this is, any war, or whenever markets have corrected, is the best time to enter into the market. There is enough data to also show that 15 to 20% corrections are very normal in a secular long-term bull market. So just like we saw from 2003 to 2008, we had several corrections which were 15%. We had 2 corrections which are also 30%. Also historically, times of war have also been points of maximum pessimism, and so they've also been great points to enter the stock market. So that's why I would suggest that if you have been sitting on the fences, you should enter the stock market. You should continue doing your SIPs. If you haven't done your SIPs, you should start doing your SIPs. If you have a corpus, you should deploy it at this point, because whenever you have deployed money at points of maximum pessimism, even if you see the recent sort of, as recent as say 2020, when there was the peak of the pandemic fear, whoever invested at that time made handsome returns after that. So that's why you should use these opportunities more to sort of enter the market. And in fact, imagine if there is something worth 100 rupees that is now worth 60 rupees. So you know, like you're getting things at a discount. So when things are at a discount, don't you think like you should go and buy? So it's exactly the same in the stock market as well. So I would strongly suggest that you should continue investing, and if you're already invested, remain invested. And I've explained to you how India is on a structural upcycle for the next 3 to 5 years, and so you should sort of continue to see sort of good compounding returns over the next 3 to 5 years. Also, I think there's a question that uh, should I be more stock specific or should I do top ups? So see, our idea is that we are providing you with an entire portfolio where we also told you how much you should allocate to each stock. I would suggest that you buy the entire portfolio in its entirety rather than trying to buy individual stocks, because the portfolio is sort of designed in a certain way, and so you should kind of take advantage of that. There are also questions around, are we going to launch more products? Yes, we are in the process of launching some more products. We're going to be coming up with a mid cap, small cap portfolio for those who are looking for, like, much sort of higher returns and more sort of a more premium portfolio. And also we have asset allocation products that we're launching for people who are looking for deploying their money across different asset classes. One of the questions is, how much can we gain in the next 5 years? I think, I cannot answer that question. But what I can tell you is that, we are very fortunate to be in at the start of one of the, great upcycles of India. And you may have seen that in China, like whoever was present in the Chinese market made handsome returns in the last 15 to years, 15 to 20 years in China. And India is sort of going to go through a similar sort of an upcycle in the next, say, at least 3 to 5 years. So I would suggest you remain invested, and you remain invested with the Teji Mandi portfolio, and you will be happy. And the question is, how do we know that you are actively managing the portfolio? So I think when you pay us the fees, I think that's part of the deal. That we are actively managing the portfolio. And there could be times when you think that we should rebalance, but we are not rebalancing. So that doesn't mean that we are not actively monitoring your portfolio. We are monitoring the portfolio actively, and only when we really think that it is time that we have to replace one stock with another. That's the only time that we actually push for the rebalance. And so I assure you that it is being actively monitored, and we want to do it. So should I do pop-ups or should I do SIP? So it depends on what comfort zone. But if you have a good corpus that you deploy, this is a great time to do it, because points of maximum pessimism are also the times that lead to higher returns later on. Should I recommend my friends and family to invest in Teji Mandi? Yes, you absolutely should. There is no reason for you not to. In fact, and your family and friends, when they invest in Teji Mandi, at a time like this, when the market has gone through a small correction, and we are in the midst of a structural bull cycle, I think they will also sort of be very happy with your recommendation in times to come. Then I think there were some questions on that what is the ideal time for the rebalance execution. So I think you should execute it as soon as you get the notification. You should not sort of try to time it or anything. Whenever you are able to sort of log into your account through the Teji Mandi app, at that point you should consider sort of rebalancing. So yes, that's about it from our end, and thank you so much.